Well, we're quite happy with the progress we made over the last 18 months. And, Singapore is a very material franchise for us, and it's a profitable one. Last year, we saw an increase of 14% operating profit, so we're happy with that outcome. And we'll continue to invest in Singapore. Singapore is a core market for us.
Early days, though, right?
Early days, because, the macro picture is still quite challenged. I think, but we like the long-term fundamentals of Singapore, right? A growth in wealth, this is still a leading financial center. So our focus is really on continuing to invest in people, invest in technology. In fact, if you look at our investment last year in technology, is up 33% over the previous year. So whilst we are very focused on doing things more efficiently, we're reinvesting that savings back into the bank.
You talk about growth. Will that translate to you hiring more people?
Yes.
Give us a sense of what you're looking at.
Well, last year in Singapore, we actually hired more people.
What's more?
More people, actually more than, we hired more than 1,000 people in Singapore, right? Both in the Singapore franchise as well as to support rest of the group. Singapore is our de facto head office, so all our global heads sit here. This is our head of our technology as well. So last year we hired a lot of people to support the investment in technology. So that's been a growth area for us. Digital capabilities, very, very important to continue to allow clients to deal with us more easily, more conveniently. So that's a big investment for us. So we've hired people. In the retail bank in Singapore, we actually increased our headcount, our frontline headcount by more than 20%. So it's a great thing because we do feel that whilst a lot of our clients want to deal with digitally, it's important that we also have really experienced advisors to help our clients.
You talked about how you're focusing on wealth as well, but when you take a look at the industry, it's consolidating. We've seen the likes of ABN, Coutts, Barclays getting out of the wealth business in Singapore. What's driving your optimism? I mean, there's rising costs, greater scrutiny. Why does it make sense for you?
Well, we have scale, right? In Singapore, we have a universal bank. So which means that we serve clients of all client segments, from retail to private banking, from small businesses all the way to international corporates. And there's leverage for us to be able to help clients with their wealth management needs. So we do have scale. And also, if you look at our platform, it's a global platform. So the investments into a great wealth management platform in our products and services and our whole research and advisory, it's something we can use globally in all our markets. So for us, we have the scale, and we are continuing to be very optimistic about the growth opportunity, wealth that's in China, in ASEAN countries. So we have to be.
Do you see further consolidation in the industry?
I think smaller players.
Who is at stake? Okay.
I think for smaller players, if they don't have the scale, and it will be more challenging. As we were saying, right, it's quite capital intensive. It's a business where it's light on capital, but very, very high cost to income from a people perspective.
Is there a need to raise the amount that a wealthy individual holds because of the rising cost in wealth management, because of the greater scrutiny? Because right now it could be anything from 500,000 to $1 million. Could that be raised to 5 million as a minimum?
No, I think we can serve all client segments, right? And we need to have the right service model to serve all client segments profitably. So if you talk about the very high end of wealth management clients, if the service is very personalized, very tailored, and hence, you may require somebody with a much higher minimum. But if you look at our bank, right, Standard Chartered, we serve retail clients. We have more than 1 million retail clients. We serve the priority banking clients, and the AUM is anywhere between 100,000 to 200,000, and we can still provide them with a very strong proposition. And this is where it's a hybrid of using technology right, to support that business, as well as good, relationship management. And with our hybrid model and with scale, we can still serve those clients very profitably. So actually, it's really depending on your service model.
I'm wondering what your views are on the economic cycle. Have we seen the worst?
Have we seen the worst
in the economic cycle?
Well, we're still seeing, it's been a pretty long sort of slowdown, global slowdown, right? We are seeing better prospect in the U.S. and that potentially will spread into the rest of the world. But Singapore long-term fundamentals are still very, very strong. And if for us, when we look at Singapore, it's an economy in transition. Right? And some of the changes in Singapore actually present really attractive opportunities for Standard Chartered, right? I talk about the society being more digital, and what that means for Standard Chartered is that our physical branch presence, and we have fewer branches than local banks, that becomes less of a sort of a limitation for us, right? So we can still grow our market share despite our limited branch presence. If you think about Singapore, where SMEs are really venturing outside of Singapore to capture the growth in our neighboring countries, right? And that's a big push. Standard Chartered, we have very, very strong international presence. We're in Asia, Africa, and the Middle East. And just last year alone, we helped more than 500 Singaporean companies that are expanding overseas in more than 26 countries. And this is where we can really add value. So, Wells, yes, short-term headwinds, but long-term fundamentals are good, and we're well-positioned to continue to be really adding value and growing our market share here. So we're very optimistic.